Hello, everyone, and welcome to Karora Resources Live Summit today, hosted by Six. We're joined today by Executive Vice President of Corporate Development, Oliver Turner. Oliver is going to walk us through a company presentation, and after we will move on to a live Q&A. So as a reminder, you can submit your questions at any time. We'll try to get to them after the presentation. There's also a copy of this presentation available for downloads under the Handouts tab on the right-hand side of your screen. And as always, the summit is being recorded and will be available to watch afterwards on Six.com. But without any further ado, I'll hand it over to you, Oliver, to get things started.
Yeah, thank you very much. And hello, everyone. Thank you for joining us for the summit with Six, just following our third quarter results that we put out this morning and our third quarter conference call, which we'd had just a couple hours ago. So I'll be walking everyone here through a refreshed deck here, which is a bit of an overview of the company, as well as it's a discussion on the third quarter results, which we just announced this morning. And after that, we can follow up with some Q&A. So remind everyone that's on the call, our usual forward-looking statements. There are forward-looking statements made in this document and some of the things we'll be discussing. So review the disclaimers at your discretion. So as a refresher for those who might be new to the story, or an introduction for those who might be new to the story, our assets are located in Western Australia, one of the best mining jurisdictions in the world. And not only that, but we're in the best mining camp in Western Australia, which is the Kalgoorlie Belt. And as you can see on the left-hand side of this slide, we have two primary operations, as well as a third operation called SPARGOS, which we added last year. It's the Beta Hunt underground operation and the Higginsville mine and mill, which is split into Higginsville Central and Higginsville Greater. All of our operations total 1,900 square kilometers of land coverage and land tenements that cover the Kalgoorlie Belt in Western Australia. And we, in fact, have the second largest coverage of that belt, or the largest land coverage that's not owned by Goldfields. So we're very fortunate to have that land position and obviously have some great assets on those properties. Our management team is headed up by Paul Hewitt and Graham Sloan. Paul Hewitt is Chairman and CEO, former CEO of Klondex Mines, who I'm sure many people on this call will be familiar with. Graham Sloan is the MD of Australia. He was one of the spearheads of the operational turnaround that we've executed over the last 2+ years. And his claim to fame was he's the man that built Fosterville and certainly put his fingerprints all over the operation and has been a great driver for us in Australia. And we're very fortunate to have both of these gentlemen down in Australia together now. Paul Hewitt is down there with his family, leading the charge with Graham at the operational level and at the corporate level from Australia. So great leaders at the top of the company. Rounding out the management team is myself on the left, head of the corporate development for Karora. I spent my career prior to this in equity research at a mining investment bank, as well as a mining engineer. Barry Dahl, the chief financial officer, ex-CFO of Klondex as well, Paul's former company. And of course, Michael Doolin, who's the senior vice president of technical services and is ex-Klondex as well. So very strong technical team or technical skills rounding out the management team here. One area which we've been focused on in 2021 and which we are proud to be pioneers in the junior sector has been the carbon neutral space or net zero space. Earlier this year, we announced a partnership with the Net Zero company, who has been helping us through navigating this complicated but exciting space, which is becoming more and more relevant, not only to investors, but also to stakeholders, other stakeholders. And earlier this year, we also announced that we were officially Scope 1 and Scope 2 carbon neutral. And that's for our two categories of emissions known as Scope 1. Scope 1 is what comes out of the tailpipe. Scope 2 is your purchase power, emissions that are related to your purchase power. We are now carbon neutral for those two scopes. Scope 3, which is a much longer process and more challenging process to quantify, we will be working on over the couple of years, and we'll be tackling that as well. But very importantly, our first step of many steps that we announced earlier this year was an investment into an Australian reforestation and conservation project, which was something that was of significant importance to us. We all remember the bushfires of 2019 and 2020 in Australia, which devastated the country and burnt down significant portions of their forestry coverage. So we were directly involved with investing in a project that is going to help recovery of that, as well as protecting biodiversity in Australia. Those were offset credits that we purchased, and we will continue to do so moving forward. That is one part of our strategy. The second part of our strategy, which is going to be the long-term driver of emissions reductions, is evaluating various technologies and other alternatives that are available to us at the operational level to remove our emissions as we progress over the next several years. So we are working with the Net Zero company and other partners to evaluate all of the options available to us, including fleet electrification, looking at hybrid power solutions, looking at fuel switching. There's a whole variety of opportunities that we are currently evaluating. And then we will be packaging up the opportunities that we feel are the most compelling and outlining a roadmap to reducing our emissions by 2030, and then of course the 2050 targets, which are other people in the sector are also doing. So it's a dual-pronged approach. We will have emissions reductions leading the charge, and that'll be complemented by our very selective offset strategy as we move forward. And more information on this whole process will be outlined for the first time in our inaugural ESG report, which we expect to release in early 2022. So certainly very exciting, something we're very proud of, and something that we want to continue to lead the charge on. Karora was the first junior gold mining company to declare carbon neutrality for 2021, and we want to continue leading the way as we move forward. With respect to the third quarter that we just announced the results for this morning, a very strong quarter. We delivered on operationally yet again, as we have all year long, and congratulations to all of our people at our operations who delivered yet another safe quarter and outstanding results, despite some very challenging weather conditions that we had towards the end of the second quarter and into the third quarter. There was record rainfalls through the entire Kalgoorlie belt in certain parts of the operations that were made more challenging, particularly in the open pits that we have at Higginsville. So our operational team did a fantastic job delivering yet another strong quarter despite these weather conditions. We did record production of just over 30,000 ounces and sales just under 30,000 ounces. That is a timing of sales issue to the Perth Mint, so we will make up those ounces as we move forward. And we continue to record yet another quarter of cost reductions. So our all-in sustaining costs of $967 per ounce was a $29 per ounce improvement over the second quarter. And that brings our year-to-date numbers to just under 85,000 ounces of gold and around $1,000 per ounce of all-in sustaining costs, which is directly in line with our guidance of 105,000 to 115,000 ounces for 2021 at all-in sustaining costs of $985 an ounce to $1,085 per ounce. We continued to build a robust cash balance on our balance sheet. We finished the quarter with just under $87 million in cash. So this is despite us, or net of, I should say, us deploying significant amount of cash into our growth programs this year. We deployed close to $60 million into PP&E. So significant investments going into equipment, into earthworks ahead of our growth plan, which we've obviously outlined to the market in the middle of the year. We outlined that to market, and we're going to be executing on that as we move forward. That growth plan will take us to 185,000 to 205,000 ounces by 2024 at an all-in sustaining cost range of $885 per ounce to $985 per ounce. So that is a significant step up from our 2020 production level of 99,000 ounces, approximately a doubling. As you can see along the bottom of this slide here, we outline a very significant capital spend in the exploration and resource development, or our drilling budget. We are putting about $20 million or $20 to $25 million into the ground per year over the next 3 years. That is a significant investment which has borne significant fruit for us in the past with material resource increases, and we will be updating the market with a refreshed reserve and resource at the beginning of 2022, and we certainly expect to see positive movements in the resource there as well. So great investment into the ground. It's certainly working out for us so far, and we continue to expect to deploy that level of capital moving forward as we continue to grow the reserve and resource beyond the production that we produce every single year. With respect to the growth capital line that you see there, our growth project is going to be focused on two primary areas. The first area is going to be a doubling of production underground at Beta Hunt. That includes a second decline, which I'll talk about a little bit later. But the cost for that second decline is around 40 or $45 million Australian. We will also be increasing the size of the mill from the current level of almost 1.6 million tons per annum up to 2.5 million tons per annum at a cost of around $50 million Australian. So combined, those two are just under $100 million. Then we'll be spending about $10 to $15 million on additional equipment. Obviously, as I mentioned previously, we'll be evaluating the use of electrified equipment as well. So for around $100 million Australian over the course of the next 2.5 years, you will be doubling your production. With respect to the financials that we reported this morning, as I mentioned, very strong balance sheet numbers that we recorded with respect to cash balance. Working capital is very strong, $73 million. We do still have $30 million Canadian on the balance sheet that was used as part of our acquisition of the Higginsville mine and mill back in 2019. We are in the process of discussing potential refinancings of that debt, and we'll update the market, obviously, with any progress there. Strong earnings and adjusted earnings. We delivered in line with consensus estimates from the street. The stock has been performing well today in response to that. So overall, a very robust financial position. And as you can probably surmise based on the numbers I gave on the last slide, we remain very well funded for that growth plan moving forward. So between our cash on the balance sheet, between our operational cash flow over the next several years, this is a self-funded growth story, a doubling of production that is self-funded. So certainly impactful, particularly given the jurisdiction in which we're going to be executing in. This is another chart here just to show, and what I want investors to focus on and viewers to focus on there is the consistent delivery since we acquired that mill in 2019. So you can see in that histogram on the left-hand side there, 25,000 ounces a quarter for a very significant amount of time. And the last 2 quarters have been around that 30,000 ounce a quarter mark. All of this executed while reducing all-in sustaining costs from the levels that they were at prior to us acquiring that Higginsville mine and mill. The doubling to 200,000 ounces by 2024 will also see our costs come down significantly. One of the important factors here is the significant nickel upside that we're seeing, which I will discuss in a few slides, particularly at the 30C and the 50C, is not baked into our current all-in sustaining cost guidance. So this could be incremental to the numbers that we've put out to the market already, and certainly something that we're very excited about, and we're drilling away at those 2 target areas and hope to better quantify them next year so we can understand the financial implications of what they could bring forward for us. A significant pipeline of projects exists at Karora. So this is probably my favorite slide in the deck when we talk about this company with investors. Lots going on here. We are focused obviously primarily on the expansion of the Beta Hunt underground, but that brings with it the LARKIN zone, the 30C nickel zone, the 50C nickel zone, and then shifting over to Higginsville, we have some very, very interesting areas at Lake Cowan called the Sleuth Trend, which I'll talk about, as well as there's Trident and the Mount Henry project, or potential project, which lies further to the south. So switching to Beta Hunt, which is the backbone of this company, of that expansion to 2.5 million tons per annum, about 2 million tons per annum of that is going to be Beta Hunt. So 80% of our production from a tonnage basis will be from Beta Hunt. The remainder will be made up from Higginsville Central and from our SPARGOS open pit mine. Beta Hunt, as I mentioned at the beginning of the call, is located just south of the Kalgoorlie town area. Of course, that's where the famous super pit is, about 20 million ounces. The Golden Mile area has 60 million ounces in total. Beta Hunt is about 60 or 70 kilometers by road south of Kalgoorlie. And you can see the current resource and reserve on the left-hand side here, about 1 million ounces at a reserve grade of 2.6 grams per ton and a resource grade of 2.7 grams per ton. We also have a nickel resource at Beta Hunt, which we have been mining, and that is predominantly remnant nickel areas at Beta Hunt, located around the A Zone and Western Flanks area. That resource grade is what allowed us to deliver about $30 an ounce in byproduct credits in 2020. As we get into the 30C and the 50C areas, we are encountering slightly higher grades there, so we would expect those numbers to improve. But there is a base of nickel in existence already at Beta Hunt, which we've been mining successfully. And of course, those who are more familiar with the asset understand that Beta Hunt was a nickel operation for the better part of 30 years prior to becoming a gold mine. So as we step into Beta Hunt, lots of target areas for us to look at. I'm not going to go through them all on this presentation, but I will focus on a couple of our more interesting areas, and then we'll step into them with a couple of slides. So just going to circle a certain area. So A Zone and Western Flanks North. just north of the A zone and western flanks where we're currently mining, is a very, very interesting area, and an area that's going to be parallel to our new decline that we'll be sinking. The LARKIN zone I'll also talk about, which is a discovery that we announced in September of 2020. Fast forward just over a year, and we've drilled it off over a significant strike extent. And that was the first discovery that we announced as Karora at Beta Hunt since we unwound the royalty package, or reduced the royalty package at Beta Hunt. And then last but certainly not least, I'll talk about the 50C nickel trough, which has the potential to be a major contributor moving forward. So with respect to the A zone and western flanks north extension, on this slide here, you can see the second decline shown in yellow, or in gold, I should say. That is a second 1 million ton per annum decline that will be sinking at Beta Hunt. Essentially what we're doing is replicating the success that we've already had with the first decline at Beta Hunt. Our current decline is doing just under 1 million tons per annum, and the operations team has done a fantastic job of ramping up production there in a very productive manner as well, in a safe manner. Over the course of the last 2 years, we will be replicating that with the second decline at Beta Hunt. But very interestingly, we believe there is potential for the A zone and western flanks north mineralization to extend up plunge towards surface. So the direction that will go, I'm just going to draw on the slide here, would basically be back up towards surface. We threw a drill rig on surface and hit some very interesting interceptions, including 40 meters of a shear zone, about 700 meters up plunge from those A zone and western flank zones. What does this mean? This means that if we continue to infill that area, and there's the potential to add resources to our current resource and reserve statement, as that second decline is being mined, we could be offsetting some of those costs with ounces from a new potential area if it continues to prove out. So that is very exciting for us, and it's an area or a factor that's not included in the current guidance, and something which we'll be updating the market with as we receive more drilling results from this area. The LARKIN zone. So the LARKIN zone, as I mentioned, was discovered in September of 2020. Fast forward a year, we've drilled it off over 1 kilometer of strike extent, 150 meters of vertical extent. And I cannot emphasize just how quickly that has been done. In a typical mine where we did not have all this underground development in place, that would have taken us several years to drill off. We've done this in 1 year. We do expect it to be a chunky addition to the reserve and resource statement next year. Not only that, but we're seeing some impressive grades coming out of LARKIN as well. So this area was discovered from existing underground development. As you can see on this slide here, and this will be familiar to those of you who've heard the presentation before, we channel sampled an area along an existing underground drift and found 14 meters of 5 grams per ton. We then started drilling through the back, encountered a new shear zone, which we believe could potentially be the offset of the western flanks, which we're currently mining. Not only that, but we also discovered a brand new zone called the 30C nickel trough. We've since drilled it off. We've put over 9 kilometers of drilling through this area over the course of 2021. And our resource geologists are busy calculating their estimates for what's going to be included in our 2022 numbers, which will be a refresh from the late 2020 numbers that were cut off in September of 2020. Our cutoff this year will be towards the end of 2021. So stay tuned on that area. With respect to the nickel at Beta Hunt, not only do we have the 30C, but of course we also have the 50C. The 50C is looking to be another potential addition to nickel resources at Beta Hunt. Not only that, but we've hit some simply tremendous grades there. As you can see in the top left-hand side of this slide, we've hit grades that range between 11 and 18% nickel. We reported some more just about a month ago where we hit 4% and 5.3% nickel. But not only that, the footprint that we've drilled off this area, or drilled this area over, is about 80 meters wide and 150 meters in strike extent so far. It does sit parallel to the old Beta South nickel resource. Now, the Beta nickel belt produced 32,000 tons of nickel historically for previous operators, and that Beta South nickel belt continues for about 2.6 kilometers to the property boundary. So what we're going to be doing is systematically stepping along our existing underground development, drilling off this area from a perpendicular angle, which is optimal for drilling, and continuing to extend the 50C nickel area. We do have quite a few drill holes that are pending assays for the 50C nickel area and other gold areas that we've targeted, which we'll be updating the market with as soon as we receive them. It's a familiar story for everybody in Western Australia and around the world. We do have significant delays in assay turnaround times. It's around 7 to 9 weeks now from the time we submit them to the time we get assays back. And of course, you do not want to be drilling blind. So you must wait for the assays back from a hole before you go off and drill another set of holes, just to make sure you're drilling the right area. But we're very excited to get these drill results back. Visually speaking, they certainly do look interesting. So stay tuned for more results from the 50C. With respect to Higginsville, we're going to focus on Higginsville Central. However, Higginsville does have two areas. There's the Higginsville Central box, which you see in gold on the right-hand side there, as well as Higginsville Central, which is a broader area that covers that 1,900 square kilometer land package shown in green on this slide on the right-hand side. The Higginsville Central area is what we call our higher grade core of Higginsville. And for all intents and purposes, that is what's going to be going through the mill for the foreseeable future as a supplement to that beta hunt feed. Higginsville Greater, which has about 1 million ounces at 1.3 grams per ton, is predominantly Mount Henry to the south, which certainly looks interesting. We're running some internal economics on it to determine where we want to target and drill in order to improve grades there. But that tonnage won't be going through our mill anytime soon at 1.3 grams. So it's certainly an interesting source of optionality moving forward. The core from Higginsville Central will come from that 2 to 2.8 gram material that forms part of Higginsville Central. Stepping into Higginsville Central a little bit, this slide will be fairly familiar for those of you who've been following the story for a while. We started off when we took over Higginsville from Westgold by mining blue, which is in the lower right-hand side of the slide. We are now mining Hidden Secret, and we'll be mining Mouse Hollow, the Mouse Hollow open pit, later in the fourth quarter as well. We have also restarted the old Two Boys underground operation. We dewatered it and have now restarted it. And our first new underground operation at Higginsville is the Aquarius mine, which you see also labeled in blue there, and is certainly demonstrating some very interesting grades to us. This is a photo of the Aquarius box cut from several weeks back, actually just over a month back. We are now driving the decline in from the box cut towards the top of the ore body. It is a narrow vein underground operation, a subvertical operation, which carries some very interesting grades, as you can see on the right-hand side there. 650 grams over 2 meters, 225 grams over 19 meters, or 1.9 meters. The resource grade, the historical resource grade at Aquarius is 19 grams per ton, which certainly provides for an interesting grade profile moving forward. There will be dilution on top of that, of course, but that is the historical Alistair grade. So we expect Aquarius to start delivering ore to the mill at the beginning of 2020. So stay tuned for that as well, and that'll help boost the grade profile moving forward. We have also restarted the old Two Boys underground operation. This was previously in operation. We dewatered the mine. In fact, the operations team found an old haul truck underground that had been submerged for quite a while and even managed to get it working, which I think is pretty interesting. We won't be using it. We have more modern equipment than that. However, this area historically produced feed in the range of 4 grams per ton. So we're certainly looking forward to getting some tonnage coming out of Two Boys in 2022 as well. And this will supplement feed from the Hidden Secret open pit area. Probably the most exciting part of our exploration profile, depending who you ask, in my opinion, it is definitely the Lake Cowan project area. This is a very, very large area which covers the major structures that host a lot of these very large deposits in the region. I'll try to draw on this slide here to give you a sense of where they are. So one of the major structures that runs down is called the Zaluka Shear. It runs all the way from Kalgoorlie in the north, past St. Ives Goldfields, underneath our property, and down past Norseman. The Zaluka Shear and the Boulder Lefroy Shears are two parallel shears that host a lot of these very large deposits. St. Ives Camp is around 14 million ounces. We've got Norseman to the south, that's about 6 million ounces. And that runs right underneath our project coverage area. So what we did last year was we ran a very large gravity survey over that area. In fact, it was 400 square kilometers. We overlaid that with our structural understanding, and we then generated a series of targets to drill between the gravity survey that we had run and our structural understanding. And we started off with an air core drilling rig, which essentially is a very light rig that sits on top of the dry salt lake bed. It drills 100-meter vertical holes to refusal, and basically you're trying to cover a very large area with shallow holes. Now, we were looking for anything over 0.02 grams per ton. What we ended up drilling immediately was a 50-meter hit of 1.35 grams per ton from very close to surface. So that was far better than anything we had expected to hit. So we then followed up with that with RC drilling, and we announced the results of these several weeks back along a new trend, which we are calling the sleuth trend. Now, the sleuth trend extends between the now historical Baloo open pit, which we mined previously, shown right here, all the way down to the Monsoon target, shown here, and it continues down to Nanook as well. It's about 5 kilometers in total between Baloo and Monsoon. Now, that air core drill that we talked about previously, that drilled the 50 meters of 1.35 grams per ton, hit a target area directly along strike between those two areas, underneath that area called the Zaluka Shear I talked about, with a large gravity anomaly on top of it. So really hitting every style of indication that you want in terms of that you could be on to potential mineralization. We then followed that up with RC drilling, which we announced a little while back, and hit 3 meters of 21 grams per ton, 0.8 meters of 9 grams per ton. And this is all next to the historic results from S2 Resources, which was 66 meters of 11 grams per ton at Monsoon. So this is a very interesting target area for us. Given the scale of what we're seeing in the region, we're certainly very keen to continue drilling here. We will continue drilling RC and eventually switch to diamond drilling here as well. But certainly an area that is very underexplored historically, and which we're excited about drilling in 2022. With respect to SPARGOS, SPARGOS is a open pit operation we acquired last year. On the right-hand side there, you see the excavation currently underway. The mining operations are progressing very well. We actually had our first ore from SPARGOS enter the mill during this quarter. So in the fourth quarter, you'll see some ounces coming out of SPARGOS. It's been progressed very, very quickly, as Graham outlined on our conference call earlier today. In just 12 months, we've done an incredible amount of work, and that will be delivering higher grade feed to the mill in 2022. The resource that you see on the right-hand side here, the lower right-hand side, is an open pit resource. That's about the first 150 meters from surface that you see there. So that does not include all of the underground potential we have at SPARGOS. But about 150,000 ounces combined of 3-gram material will be coming out from an open pit perspective into our mill. So certainly a great source of supplementary feed there. Not only that, but we have some tremendous exploration potential at SPARGOS. You can see some of the drill results on the left-hand side of the screen here. An ounce per ton over 19 meters, another ounce per ton or close to an ounce per ton over 15 meters. So certainly a very, very interesting area for us to continue to explore, and very similar to other deposits that are in the region. So stay tuned in terms of exploration results out of SPARGOS. Once SPARGOS is exhausted as an open pit mine, given what we're seeing, there's strong potential for this to become an underground operation moving forward, and certainly looks like a good acquisition for $4 million in cash up front, $6.5 million in total consideration that we transacted on in 2020. This is the path forward for Karora. When we look at some of our peers and where they're valued, the average production of this group is about 200,000 ounces per year. Average market cap's around $1.3 billion per year. $1 billion in terms of that market cap. We certainly have had a good run in the stock over the last month. I talked about some of the reasons for that earlier on the call this morning, the conference call that we had. We had some pressure on our stock towards the end of September due to some publicly traded warrants. Once that pressure came off, we basically had some very strong institutional buying from some new shareholders, which also triggered some important technical triggers for us, which is very important in today's quant trading world. We crossed the 50-day, the 200-day moving averages, which helped to drive our share price upwards. And then, of course, the entire sector has been enjoying some capital flows back into gold mining equities, which we've participated in as well. However, when you look at where we're growing, there's certainly growth on the market cap side to come as well. This is just a summary of the analysts that are covering us, and kind of gives you a snapshot of the company along with that strong share price performance in the last month and a bit here on the right-hand side there. we're well covered by 8 analysts, and certainly they're doing an excellent job for us. Strong institutional shareholders as well, who continue to build positions, and a very strong financial position, as you can see in the upper left-hand side. So I think at that point, we'll wrap it up now, about 29 minutes in, and we'll hand over to questions.
Yeah, so we're going to jump into the live Q&A. So if you do have a question, feel free to submit them now. So Oliver, through the first 3 quarters, it appears that Karora is on track to beat production guidance and be on the low end of cost guidance range. Would you say that's a fair assessment?
Yeah, look, I mean, we're definitely well positioned to deliver on our guidance. We're probably tracking a little bit ahead of where we expected to be at this year, which is always a good position to be in, particularly given the challenges that we've had over the course of this year with some of the weather events and COVID restrictions with respect to labor impacts. But well positioned to deliver on that guidance. We're feeling good. We had a good October as well. Hopefully November and December execute as planned. I have a lot of confidence in our operational team. So well positioned to deliver. Not going to make any promises that we're going to beat, but we're feeling quite comfortable where we are.
Great, thank you. And as you said, Beta Hunt is a gold mine, but you noted that there has been some high-grade nickel discoveries as well. Can we look forward to increased production and byproduct credits from nickel?
Yeah, certainly. So we have been remnant nickel mining for a couple of years now, which has provided us with some decent byproduct credits. However, as I outlined in the presentation, with the 30C and with the 50C, those 2 areas are looking very interesting. We've conducted some test mining in the 30C area, which is going well. We expect both of those areas to deliver on a production basis probably in the latter half of next year. We're working on quantifying the scale and size of them, particularly the 30C, which is a little bit more advanced than the 50C, even though the 50C is certainly looking more interesting. So they will be contributors in 2022. It will be more meaningful than what we're doing today, but we haven't quite quantified that yet. When we do have that quantified, we will be outlining some of those numbers to the market.
Got it. Thank you. So the cash balance is nearly $87 million. Aside from the growth plan, do you consider using other capital, such as paying down your debt or the possibility of dividend at some point?
Yeah, I mean, so when we look at our capital allocation, first and foremost, we want to make sure that operations are stable and we have the cash on hand that we need to execute our vision. So we do have a large capital requirement coming up for this growth plan. However, with our operational cash flow that we project, of course, we're very well covered to cover that amount. So when we look at alternate capital uses, basically we look at where can we deploy a dollar that's going to give us a stronger return or a multiple on that dollar. Dividends are certainly something that we've looked into. Of course, we've revisited refinancing the debt. So all of these options are being looked at. We even triggered some of the NCIB earlier this year. So we have multiple tools at our disposal. But first and foremost, we must make sure that growth plan is well capitalized and well covered. And that's what we've been working on over the course of the last 2 years, really. That's why we've been building up cash. And that's why we continue to maintain cash despite putting capital into the ground as we have so far this year.
Thank you. Richard's asking, are the Western Australian restrictions affecting the labor availability?
Yes, I mean, that is a reality of working in Western Australia right now. Thank you for the question, Richard. We all know that Australia is starting to open up. The East Coast states have opened up. You can now fly into Sydney. If you're Australian, you can return to your country as well, which is fantastic. We expect Australia to continue to open up more. Western Australia has been a little bit more restrictive than the rest of the country. It does remain closed at this point. There hasn't been any strong commitment in terms of when they will open that up. However, one thing that is correctly identified by Richard here is a large portion of the labor force in Western Australia that works in the mining industry comes from other parts of the country. In fact, it's about 30 to 40% of the mining force comes there. So when that border closure does open up and you're no longer required to double quarantine on either side, we do expect the labor tension and the tightness of the labor market to ease there a little bit, which I think will be welcomed by the entire sector. So that news will certainly be welcomed by us.
Right, absolutely. Antonio's asking, is inflation affecting your mining plan towards 2024 for doubling the gold production?
Thank you for the question, Antonio. On a capital basis, we are very comfortable with the numbers that we've put forward. We outlined at the beginning of the call the 40 to 45 million for the second decline, the $50 million for doubling, or not quite doubling, but increasing the mill capacity. So we are comfortable on the capital side. There could be some input cost pressures with respect to consumables, particularly things that have to come from overseas. So like everywhere in the world, we are seeing supply chain restrictions and tightening coming in. Shipping costs are up dramatically, no matter where you are in the world. Certainly not the least if you're operating on an island that's surrounded by water. A lot of your consumables have to be shipped in from Asia. So we are seeing some supply chain costs increasing, but we do feel comfortable on the capital side.
Great, thank you. Michael is asking, is there a date plan to be debt-free?
We don't have a date target. We are in discussions with several parties to renegotiate the debt, as we've talked about previously. So that process is ongoing. The growth plan was a very important document and set of data for those various parties to evaluate. The debt process does take significantly longer than any other due diligence process, because they really do like to stress test their assumptions and the operations. So as we progress through that discussion, and if we end up reaching a constructive conclusion here and refinance it, the market will know, but we won't draw a line in the sand and say by this date we will be debt free.
Right. Thank you. Another question here, is buying carbon credits a part of the plan to reach your ESG goal?
Yeah, so it forms a component of the strategy. As I mentioned before, first and foremost, we're going to be focused at the site level at emission reductions initiatives. That's based on various technologies. Starts with things as simple as potentially fuel switching, improving efficiencies, evaluating the operations at sort of an all-encompassing level and a very thorough level to figure out where we can reduce actual emissions. That will be complemented by strategic investments into offsets, which basically coincide with the values that Karora has. We do want to make an impact in Australia. That's why we invested in that Australian reforestation project. So it'll form a complementary part of the program, but certainly not the entire program. It will be led by emission reduction at site.
Got it. Thank you. Jürgen is wondering how the registration on the Australian Stock Exchange is coming.
Yeah, so the ASX is certainly something we continue to evaluate. We've been saying that for a while now. There are certain windows in which you want to look at listing in Australia. So it is something we continue to look at. There is a lot of demand, particularly from Australian superannuation funds. There's a lot of capital that's captive in Australia, cannot leave its borders, must be invested in Australian equities. So there is demand coming from the ASX for listing there, and we are evaluating the most strategic and the best way to do it. So something we continue to look at moving forward. Yes.
Great, thank you. Rainer is asking, would you generally say that to grow production at an existing mine is cheaper than to build a new one?
That's a very good question, Rainer. So with respect to cost, I think there's two things you need to look at. So number one is cost, and second, of course, is risk. So if you start looking at a risk-adjusted return, when you own these assets and you've been operating these assets for a long period of time, you understand where the strengths and weaknesses of various asset types are. You know your risk. You understand your risk profile. We are expanding a mill that we've been operating for the better part of 2.5 years. We are expanding an underground operation, which we have executed our strategy on very well over the course of the last 2.5 years in terms of increasing production to 1 million tons per annum. So we really understand those two assets very, very well. Of course, when you look at acquiring other assets, part of our role here, of course, is to look at other assets and to evaluate them from a technical perspective. But ultimately, they're not your assets, and your due diligence can only go so deep. And as we all understand in the mining industry, the majority of the time things go well, but sometimes they can be challenging as well. So executing this program on our own assets and increasing production from our existing asset suite is a far lower risk way of increasing gold production, and on a risk-adjusted return basis is certainly more compelling than going out there and buying something which we are not as familiar with.
Great, thank you. Antonio is asking, how is your development of your mill going? Can you give us more detail on how it's going, and are there some challenges which you encounter in the building process?
Yeah, so we are currently reaching the end of our phase 1 mill expansion, which has taken the mill from 1.4 million tons per annum to 1.6 million tons per annum. It's predominantly been a debottlenecking exercise. That's where we were able to do it for about $3 million Australian. So that's gone very, very well. The majority of it is done. What we are waiting on right now is the final installation of one of the major screens, which is expected to be completed before the end of the year here. In fact, Paul and Graham are heading up to site tomorrow morning, or I guess just in a few hours in Australia, in order to evaluate that entire process. So it is progressing very well. We are reaching the end of that first phase. And once that phase is complete, we will then transition into preparatory work in ordering long lead items for phase 2.
Great, thank you. We have a question here. Any way to speed up assay results?
Yeah, I mean, I wish we could. We are at the mercy of assay labs, just like everyone else in the region. We're not alone when it comes to wishing that we could get assay turnaround times, in a couple of weeks rather than 7 to 9 weeks. One of the things we did over the course of this year was we did construct an on-site assay lab ourselves. So now for our grade control drilling, which does not need to be sent to an external party, so that's a lot of your production drilling, we're able to turn around a lot of those assays ourselves in-house, which is fantastic. And then we can also prep a lot of our samples that do go out to the external labs with a third party on site. So we've done those two things in order to increase our assay turnaround times. But ultimately, of course, it's unsurprising. Everybody in Western Australia has been generating significant cash flows. They have expanded exploration budgets. They all want to get more assays turned around at the labs. And then conversely, at the labs, of course, due to COVID-19 staffing requirements, they're operating below 100% capacity. So it's kind of been a double-edged sword for us. It's been challenging. We do hope that they will improve with time. And as Richard's question was at the beginning, with the borders opening up here, perhaps some of those COVID-19 restrictions will ease and we'll get more people back in the lab and things will speed up. But I wish we could do that ourselves.
Right, absolutely. Another question here. Has a decision been made to go underground mining at SPARGOS?
So a decision hasn't been made at this point, but if you remember that cross section that we looked at earlier, so the top 150 meters there is hosted in that open pit resource. It's that 150,000 ounces that we have at around 3 grams, or just over 3 grams when you blend in the inferred ounces. So that is the open pit resource. We do not have an underground resource at this point in time at SPARGOS. However, some of those exploration results that we've announced that were below where the ultimate pit end will be are certainly supportive of further evaluation. So we'll continue to drill that over the course of next year and evaluate whether we can go underground at SPARGOS. But at this point in time, it is looking very positive.
Right. Well, thank you so much, Oliver, for taking us through the presentation and the live Q&A. And thank you, everyone who submitted all these great questions and tuned in today. If we didn't get time to get your question answered on this call, we will be sending out a short survey where you can leave your contact information, and the Karora Resource team will be happy to follow up with you directly. You can also find more information at KARORA'Resources.com, and all their contact information is on the slide here. But before we close out, I'll pass it back to you, Oliver, for any last words.
Yeah, no, I'd just like to thank everyone for attending and thank you for your continued support. It's obviously been a fun time to be an investor in Karora, and we're certainly excited about what we have ahead of us here over the next several years and even in the next 6 months with some significant catalysts coming down the pipeline. So.